And bear with me, let me set up the breakout room just a moment. So let's see. Okay. Bear with me, I'm just setting up the breakout room so you have a chance to talk to your team about the questions from the other team. Make sure I have the, hold on one second. Let me make sure I have everyone in here. Okay, so what I'm going to do is we have the group presentation first, but then I wanted to go through the couple of the questions, the group questions. Each group has several questions. I think you have questions within questions. So I wanted to make sure that you as a group have a chance to discuss how to answer those questions through your presentation. So the first thing that, that we'll do that, and I wanted to go through the research question paper that you did. So for the most part, good starting point. Some of you have feedbacks for me that I'm confused or things like that. The idea here is to help you narrow down your research questions. And you should have 10 articles identified, the past research identified in your research questions. If you don't have that, make sure you have them because you will need them for the literature review in week 4. So make sure that you have that. Then when we go through week 4 assignment, which is your first literature review, that's where I expect you to provide your revision of your research questions paper. Okay, so the feedback that you receive from me today, I'm not looking for you to revise it until week 4 submission. So you could do that in week 4. And in week 4, your literature review should be your first set of the 5 articles. And in week 5, you write the second set of the 5 articles. Now, some of you are going to run into problems. For example, you pick 10 today, and you realize when you're writing the first 5, you realize, oops, one of them has nothing to do with your research question. And you have to go out and find another one. So that's the purpose of writing first set of the 5 and the second set of the 5, because they are possibly the articles you pick today doesn't quite fit. Or when you're writing it, you need the 6th or the 7th articles to go with your literature review. So that do happen. But what I expect you to do in week 4 is to submit the revised research questions along with the research literature review, the first 5 sets of the articles. For the most part, I kind of understand what you are trying to accomplish in terms of research. My job is to help you narrow them down so then you don't go all over the place. Because the purpose of this is really just to help you get to a point of that research is usable for your practice. So don't go too crazy about covering everything. We don't need to cover everything. We just need to cover 1 or 2 questions. Then we're going to go through the group questions. Each group has a few questions from the other group. We'll do about 5 minutes breakout session first. Have you talk with your team to decide who is going to cover and how you're going to answer those questions. And if we have time at the end, I'll go through 2 more questions within the presentation today on my slides. And if we have time, I will really hope to have everyone hear 2 business model examples from this week. They are fantastic. So hopefully that we'll have time to do that. First one is from Chris, that I hope you don't mind to share. The second one is from Jeff, that I thought that was a very interesting business model that we all ought to learn. So if we have time, then we'll come back to the 2 examples that I see through the assignments. If we don't, then we'll find time the next time around. All right, so what I'm gonna do is now I'm going to break everyone into your group. We'll have 5 minutes discussion about the other group's questions. And that comes in from the questions on each group writes a question for the other group. And I highlight a couple of the areas primarily because I'm thinking you are asking more than 2 questions. So I'm going to let you decide how are you going to answer the questions. And if you don't have time to answer all the questions, that's okay too. Because I'm pretty sure your presentation already addressed some of these questions. And when you go to that presentation, when you're presenting that slide, you can simply point out, here is the questions from the other group. Here's our answer. Things like that. So I'm going to give you about 5 minutes to talk to your team and to figure out the flow of your presentation. Once we've done that, we'll come back with your team to do the presentation. Questions before I get you into the breakout room. Any questions from anybody? Okay.
Can I ask a question, Professor?
Sure.
For the research questions, normally, according to my understanding, the research questions, when we're working for a research paper, we set up a topic first, then find an article to get some information, narrow down the research. Is it right? Or we need to find some articles to read first, then get the topic of my research paper. Which one is right?
You could do both.
Both?
Do both.
Okay.
Yeah.
Okay. So if I'm sorry.
The way of doing this is that you are reading a research article and you either strongly disagree or see a gap of an existing research. That's where you come up with a research question. Typically, that's the case.
Okay, if I set up my research topic first, but after I read the research articles, I found something wrong. So can I change the topic? Yeah. I can change it?
You can go back and change your research question. But once you've gone through literature review, you should change your question.
Okay.
Once you've gone through the literature review,
okay,
it's all set.
Okay, I can't change it.
You can't change it after that. So while we are still looking at that 10 articles, this is still a good time to evaluate, is this the right research question to do? If it isn't, you revise your research questions accordingly, then you go right into the literature review.
Okay. Okay, thank you.
Does that make sense?
Yes, because sometimes I found that this is a problem. Because if I set up a topic first, when after reading some articles, I found something, it's different.
That's right.
Maybe my thought, original thought is wrong.
Yeah, sometimes you do that. Yeah, so that's why we break it down to 2 literature review. So you still have a chance to make some changes.
Okay.
But once we are done with literature review, you're done.
You mean after week 5?
So week 4 is a literature review 1. Week 5 is a literature review 2.
So after week 5, we can't change it.
No, because it will be too complicated to change it after that.
Okay, I got it. Thank you.
It will be way too much work on your side.
Yes.
Not necessarily on my side, but on your side, you will have a lot of problems. So I would encourage you to read my comments this week. Make the changes as much as possible now. Because once you are in literature review, even to change your research question could also impose some problem on your end, because that may require you to look for other research article. And when you go look for other research article, you realize that, well, that article didn't tell me anything.
Yeah,
sometimes I have to go somewhere else, and then you get stuck. We don't want to do that.
Yes. Okay, thank you.
Yep. Any other questions before I put you into the breakout room? Make sure
I haven't read the comments yet on my research paper, or the final paper, but did you come across anyone's paper or topics? I'm actually more so just asking for myself, where you just thought it was so outlandish, or like didn't really.
It just doesn't. Most of you doesn't have enough narrow Meaning that you might give me one sentence, but there are 3 questions in there that you didn't know. So no, most of the research topics or questions are really right on. It's just that because you haven't really formally write some research yet, then you tend to be asking 3 or 4 questions in one sentence, which then my job is to help you narrow it down. Not to do 4 things, just do one, or do one related questions of that one question that you have. So it will be narrow enough and it will be easy enough to find the related article associated with that.
Okay.
Yeah.
I have a question.
Okay.
So the research paper at the end, it's just going to be us putting together all of the modules into one paper, right? Then editing it. So as long as we take your notes into it, and also is the final paper grade, is that divvied up week by week, or do we get one grade at the end?
So no, every week you have a grade.
Okay.
For the papers. So each module you're writing, there's a grade. And then at the end, when you combine everything together, a presentation is a grade. Your final paper is also a grade.
Okay.
Yeah.
So as long as we, take your notes and, of course, incorporate your notes, we should have a great paper because each module is a section of the paper. Okay.
Yeah, because the idea here is to get you to a point enough after almost close to the end of the course, you could decide, all right, am I going to actually publish this? If you are, there's some more work you need to do after the class. If you're not, that's okay too. But the point is that by the time you present, you should have a pretty solid paper to move forward in terms of continuing the research, if you will.
Got it. Thank you.
Okay. Any other questions? All right, I am going to put you into the breakout room, so stand by and I will try to jump between the 2 rooms as well. All right, stand by 5 minutes for the discussion. Oh, sorry that Logan, I forgot to put you in. Logan, you are at, hold on, I'm gonna have to put you into the right group. Logan is in 2, okay. Chris is in 2 as well. Okay, got it.
Yeah, well, that doesn't help me. I gotta.
All right, welcome back. Hopefully I got everybody back. You actually never know that if I can get everyone back. All right, looks like everyone is back. All right, so which group would like to go first?
Group 2 can go first this week.
All right, you can take control of the share screen, please.
Which group is going first?
Group 2 says that they will go first.
Oh, okay.
Keep getting a message, host disabled, attendee screen share.
Okay, my mistake. Okay, try it one more time.
Let's see. Cool. Can everyone see this?
Yes.
Perfect. So welcome to week 3 group presentations. This week we will be going over insurable value. So with that, we'll start with a little bit of information on risk and insurance. So essentially, we will all encounter risk in our everyday lives and our businesses. There's 4 ways to handle these risks. You can try to eliminate them, reduce them, retain them, or transfer them. So if the first 3 options generally aren't available or aren't something that's going to accomplish exactly what you're looking for, you can generally transfer this risk, and that's where insurance comes into play, is you transfer it essentially to the insurance company with whatever you're purchasing. With that in mind, insurance can be expensive, and it can be certainly something that you need to consider carefully, but you'll generally want to use it for infrequent occurrences that can be very expensive or have some sort of adverse impact to your business. There can be a lot of different goals for purchasing insurance. Sorry, went a little too far. What we're generally going to talk about is reducing cost of capital, right? So for a private business owner, if their company is seen as being very risky, whoever's going to invest in it is going to demand a higher premium or higher return on their investment for taking on that type of risk. So if you can manage your risk, reduce it, make it as low as possible, certainly it's going to help you in both attracting investors and certainly the cost of capital for what they're wanting in return. It can also impact your ability to generate returns. We talked a little bit about reducing the perceived risk, with that reducing the cost of capital. And we'll also get into how it can be used for liquidity or continuity planning going forward. So in the world of insurable value, the value of a business or business interest is to be covered by insurance is essentially what we're talking about. There's numerous reasons you might request a valuation within this world. The ones we're going to focus on are funding a buy-sell agreement, determining proper amounts of key person insurance, valuing a claim in business or interruption cases. There are 2 authorities in this world. There's the very regulated part of insurance companies, and also the involved parties are authorized to also create this valuation or request a valuation in certain circumstances. The world is mutually exclusive from other worlds. The processes are specific to its goals, and the value conclusions that are derived do pertain specifically to this world. With that, we'll turn it over to Jeff to talk a little bit more about buy-sell agreements.
All right, so I'm not going to spend a terrible amount on this page, primarily because Chris Etter basically did the same page. I don't want to take too much from him, but it does just give some quick ideas of what a buy-sell agreement is. And buy-sell agreements, of course, are extremely important to all parties involved, which are basically the owners of the company. And the second bullet point here mentions it's one of many tools to achieve business continuity. It's not the only tool. Of course, there's some benefits with buy-sell agreements. Of course, is that one of the things that avoids probate. There's some other things that each individual could do to possibly, transfer ownership to kids or other people. But of course, that very often of course, would have a very large impact on other partners or other owners of the business as well, which is really why the buy-sell agreement is sort of the flagship of what anybody really should or can do as far as additional estate planning or business succession planning to ensure continuity of their business. It's kind of driven somewhat by that buy-sell agreement. So go ahead and go to the next slide here. And in the book, it has what's called this buy-sell decision hierarchy. So first of all, the owners really need to determine what type of buy-sell agreement they're going to use. And when it says what type, really for the most part, there's two types of buy-sell agreements. You could say there's hybrids or some other things, and yes, there's other types, but for the most part, those fall into two categories, which is the entity buy-sell and the cross-purchase buy-sell. And with the entity buy-sell, that's where the company itself owns the insurance policies, for example, on the owners, so that the company basically is buying back those shares. That, of course, would go to increase shareholder equity for all of the other owners. Don't need to go into all the math. That's going to be covered in some later chapters. You could also use a trust to do an entity buy-sell. Gets a little bit more complicated, but still a possibility. Cross-purchase is when each owner owns insurance on each of the other owners. So when you're looking at that, what becomes difficult with that is that if you have 10 owners, all right, you would need 90 policies. And that gets pretty burdensome, how you're really going to manage these 90 policies in order to cover all 10 of the owners is pretty challenging. So that's really where a big driver with determining if it's going to be an entity buy-sell or cross-purchase buy-sell comes in. And then, of course, it has to do with if it's a cross-purchase and I'm in excellent health and you're my partner in very poor health, it's going to cost me a whole heck of a lot more money to own that policy on you. And that sometimes comes into play, especially if you have some unhealthy partners. So then, of course, decide the major provisions of that, and then apply valuation mechanics, which I'm going to be talking about on the next page, as far as some of the steps you could take to actually do the valuation to determine what the price will be for the shares. And then you've got the triggering events, which is going to be covered a lot more, I think, right after I go, but it's in here. We're going to talk about that. And then choose funding technique, which I just mentioned insurance. Remember, funding techniques, there's different triggering events. Most people think that a triggering event is death. So therefore life insurance is a big part of that. But what about disability? What about something that maybe one of the partners gets into some very serious trouble and it makes the business look very bad? Divorces, there's a lot of things that could fall in there as far as determining how the funding is going to be used to buy that out. Not every business partner is not every business is going to have the cash available there just to buy something out when a triggering event comes in. So there's a lot of different types of funding techniques in order to handle that, and all of those different triggering events need to be considered for that. So go ahead and go to the next slide, please. So this one, we're looking at some of the different valuation mechanics. And the first one is negotiation, negotiation between the parties or among the parties involved, all right? So really with that, here it says, it's used in the absence of a buy-sell provision that determines the process to value the business. A lot of times what business owners could do is simply when they have their annual meeting, come up with what a price they all think is fair for the value of the business, and that's what the value will be pegged for the upcoming year in case a triggering event occurs. So everybody gets involved with that. Who's got a better idea of what the value of their business is than the business owners themselves? If they could come up with an agreement for that, then it's probably a pretty easy route to take. So they could set the fixed price. If they're unable to agree upon that, as it says in the last bullet point, that the formula or outside appraisal can be used to determine that valuation. So that's really, we're looking at the next couple of things, because it can't always be, especially when a company starts getting much larger, especially when there's a lot more owners who are involved with the buy sell, coming up with a specified price for each owner's share, it's going to make, it can become a lot more difficult. So then with the formula approach, that's actually where they can't come up with a dollar amount as an agreement in their annual meeting. They could say, all right, well, we're going to use a formula approach and set that ahead of time. And there are some benefits to doing that because it requires some planning in advance. on how you're going to do that. It could be something that you've got a highest value approach. So one of the things that a lot of times when companies are small, they're going to say, all right, well, the buyout value is basically going to be our book value. But at some point, most companies are probably going to be more valuable, especially when you start looking at goodwill and a lot of these other aspects of the value of a company. It's probably going to be more than book value. So there's some problems in there doing that, especially when a company becomes larger and more successful. But it would still be considered as part of the formula method. Then you could look at some different ways to value the business, where you're looking at, you know, cash flows, annual sales, revenue, a lot of different those types of ways to kind of get, you know, EBITDA, you know, taxation, some of these different types of methods, and then come up with and say, what we'll do is we'll use the highest of those values, or perhaps an average of those values, in order to determine what the fair share price is for anybody who's leaving the company when a triggering event occurs. And then, of course, there's outside appraisal. And outside appraisal is where you're finding an outside objective appraiser to come in, look at the books, look at the company, and come up with a value. And with that value, or with the outside appraisal, it's very important that the company puts a lot of things in writing beforehand when they've determined that there will be an outside appraisal. Because the outside appraiser is going to need to know, all right, well, there are going to be valuation discounts involved in the purchase price. All right, that's a big part of it. There's pro rata without discounts, straight pro rata, or a percentage of pro rata. So that needs to be determined ahead of time so the appraiser knows. And of course, trying to find a certified appraiser, trying to find somebody who's objective is critical in that as well, because you don't want that person being influenced by someone else. Now, one of the questions we had kind of asked about using the formula method, is that something that could lead to potential unethical things involved with some of the partners saying, well, we're going to use this formula method. Let me suddenly drive a bunch of sales, you know, sandbag sales, something to that effect, in order to try to manipulate those numbers. And I guess to some extent that's somewhat of a cynical way to look at things, but still we need to look as business owners at the cynical side of things. Trust me, I know. I had a, quote, best friend who called me his brother who screwed me out of a business once. So sometimes the last things you'd expect are probably the most likely things to occur, but that's also where you're looking at some averages over time. It's not saying we're going to look what our numbers are today. Maybe this year was a poor year just because of the business cycle. Maybe this year was a very good year because of business cycle. So it's good to look at a certain number of years to help with that valuation. So it's not just based on a quick snapshot of today. You could also look at some things about some future cash flows, maybe with your accounts receivable that you haven't yet collected. You know, a lot of that aspects of it would make it awfully difficult for any one of the other owners. And I doubt they would collude and get together and all say, hey, you know, this guy's leaving, let's kind of screw him on the share price. That'd be awfully difficult to do. Of course, there could be some liability with that if that was discovered, which probably could be, especially if an outside appraiser ends up coming in because there were some disagreements. So anyway, that is pretty much what I have. I've probably taken up more than my time, so I will send it.
Let me ask something before you go on. So typically, besides what Jeff just mentioned, of all the three things that you see in front of you, typically what's going to happen is that the trigger events tend to tie with one of these, either an outside appraisal or formula or negotiated, depending on what kind of trigger events. And that needs to be stipulated right in that buy-sell agreements. Now, when you actually work with the business, they may tell you that they don't have buy-sell agreement. As a matter of fact, by default, most of the buy-sell agreement shows up in the operating agreement. So instead of asking buy-sell, you probably need to take a look at the operating agreement. The operating agreement have a section of the buy-sell. It's probably not going to be that much detail if they haven't gone through this mechanics of the valuation. In the buy-sell itself, that section, there are 7 different triggers, which I'm sure you're going to talk about in just a moment. Each one of those triggers will stipulate what type of valuation method is supposed to be deployed. Or in the absence of XYZ, then we will use a backup type of methods in place. So all of these are somewhat negotiated among partners to make sure that they are there. Now, as Jeff mentioned that, yes, annually, you're supposed to go through this, and annually you're supposed to look at, are these methods and the triggers still match up with their current operating environment? If it doesn't, then that will be the time they have to figure it out and update those agreements accordingly. So it is really crucial that for you to advise the clients to not only look at their operating agreement, as well as the buy-sell, as well as the methods go with that. All right, thank you.
Yeah, and
let's
I
go
would,
to that next page.
I would mention really quickly too, when you're looking at that, it's, in my experience, I have found business owners that I've had to really impress upon them, don't be too parsimonious. Okay, I know nobody likes to pay money to an appraiser or an attorney or to anybody to come in and help with this. But if the company's got millions of dollars in revenue and the owners are doing just fine, and they've got to spend $30,000 each year to get an official appraisal from an outside appraiser, it's going to absolutely be in everyone's best interest. And with the
That's
company,
right.
especially if later on they start doing things, want to do an employee stock ownership plan or phantom stock or something for the employees or for some key personnel, getting that outside appraisal makes a lot of sense. And when you take that dollar amount
Yes.
as an average of their total revenue, you know,
Right.
don't be a tightwad.
And in addition to that, just having that outside appraiser comes in really gives you the third-party views of what's going on. And in case of dispute, there are always going to be a dispute. It may be a very harmonious partnership, but if one dies and the spouse gets into the picture, all of these will go away. All of these will be all different. So you wanted to make sure that outside appraiser is on your side in case if you have to justify that in court.
Okay, thanks, Jeff. So just to kind of reiterate what Jeff had said on the buy-sell agreements, it's the binding contract between the various owners that controls when an owner can sell an interest, to whom they can sell it, and for how much. And basically a lot of that, per what Professor was saying, comes down to these triggering events. So I won't harp much more on this slide because Dave did a good job covering that as well. So on the triggering events, again, as Professor stated, everybody's buddy-buddy when these things are written up. But when the triggering event starts, sometimes people aren't so nice. So what's listed here are a few of the common triggering events. You got death, long-term disability, voluntary termination. I would slide in there retirement with notification. The book gives an example of somebody retiring with 12 months notice so that they had plenty of time to hire someone in their place. And if that's the case, then they should not receive a discount on that triggering event. Then you get into voluntary termination, involuntary, and third party, which are, again, the examples Professor brought up with a bankruptcy or a divorce. And basically what you're trying to do through these different formulas and different ways to figure out the values is to penalize people against these actions so that the company is not harmed ultimately. And I'll give you 3 examples that I've either heard through fellow classmates or have myself dealt with or colleagues dealt with. The first one deals with 2 dentists. You had an older dentist and a younger dentist. And again, you get into the insurability of one being older than the other, and then the health of each of them. Well, in this scenario, the older dentist suffered a stroke and could no longer perform certain procedures because one of his hands was partially paralyzed. And so the younger dentist carried him for about 6 to 12 months. The problem with the buy-sell agreement is there was no long-term disability in it. It was only life insurance so that if he died. And so that was a pretty big hole that that planner had left. When everybody hears these buy-sell agreements, they just think that it has to do with life insurance. And that's not the case. Majority of the time, it's a disability due to sickness or injury. The second example is two of my clients that were in the oil business out in East Texas. And when oil was booming, everybody was doing great. They did a bunch of lease title work. One of the partners came from a well-to-do family, the other one not so much. So when oil collapsed, the one partner had family money to fall back on, the other partner didn't have anything, and they owed over $500,000 in obligations, whether it be for office space lease, equipment. They even, I found out, had their cars in the company's name. And so the one partner that didn't have any family money basically had to file for bankruptcy, and they had to dissolve the company. And then I stepped in and basically just made them give each other their policies back to each other so that they could own it. The third situation was a divorce. A husband and wife raised a family. The husband had a partner in his business. The partner, wife went off on vacation on a girls' trip. She came back and divorced her husband immediately and took half the company. And he thought everything was hunky-dory and great, and turns out it wasn't. So the other partner ended up having to deal with that spouse's wife all of a sudden as a quarter interest partner. And so you want to make sure you get every single layer of the onion covered up on these deals. So those are my examples of the triggering events and how they can be impacted. You want to make sure every I is dotted and T is crossed. So I will turn it over to Dave now to talk about.
Before we move on to the next page, there are two more trigger events that are not listed in here. The other one is called the personal liabilities in lawsuit, right? You could potentially get into a car accident and somebody can find out, you know, you have a deep pocket in this company. They can sue you for that. So that's another trigger you have to address. If that trigger happened, then what type of valuation should be used? And usually these type of trigger, you wanted to make sure to use, you know, the bare minimum, things like that. The last trigger that was not talked about, and that's pertaining to our professional industry, and that is the, what if your license get revoked? So this is a professional license. And this could be your dentist, this could be your physicians, this could be your CPAs and attorneys. When your license get revoked, if you think about things like a CPA firms, without a CPA, they cannot even own that company. Without an architect license, they cannot own the company. So when that happened, then a certain trigger event, that's considered a trigger event that's supposed to be part of the agreement as well. So don't forget about these two additional trigger events. Right, thank you. Let's go to the next page.
Thank you.
Thanks, Chris. And the last story was very uplifting. So I'm going to talk about key person insurance. Key person insurance is an insurance policy that may be taken out on an employee whose contribution is considered uniquely valuable to the company. These may not be readily identifiable, especially in kind of a smaller setting type of firm. But you know, it's someone that essentially is, it's the company loses them, they're in a bad spot, and they need to make sure that the company is covered in case that person passes or decides to move on, or whatever the case might be. Some reasons to put the policy in place other than what I just specified: used to identify and attract and train replacement employees, right? That the key person leaves. Redeem the stock that was owned by the deceased shareholder if someone were to pass. Fulfill contractual obligations to continue to provide a portion of the deceased employee's salary to family for a period of time. You know, a lot of times we don't see as much, but especially historically, there's typically one person that goes to work in the past, and now that's changing. But if that's still the case with a family and a business owner, you know, that family really could use all the help they can get if that person were to pass away. Funds that may maintain the stability of the stock price in case no funds are available to purchase the deceased employee's shares, and to use as mitigation tool to comfort creditors and shareholders. You go to the next slide, please. There's three methods to help and estimate the worth of an employee. One of them, the most common and simplest one, is the multiple compensation method. which assumes the employee's value is accurately reflected in their total compensation. Then you multiply it by the number of years it will take to train and replace that employee. Right, so they make 100,000. It's going to take 2 years to replace them and get someone trained and ready to go and rocking like they were. Then you're looking at a $200,000 policy. Contribution to profits method associated the employee with a particular part of the profit to the company. Big client would leave, they weren't there, and how many years it would take to find a replacement of that employee. I was the previous employer I was at. I brought in 3 big businesses that were there primarily just for me. I ended up leaving the company, and as soon as I left, they left as well. And so it would have been smart for the owner to get out a policy on myself, apparently, but you know, that's how it goes. Cost of replacement method, direct costs required to interview, hire, and train a replacement, plus the opportunity costs for the headhunters and training and having that position filled, and how that will affect the company. Next slide, please. Type of insurance used. Most of the time, permanent insurance is used because it produces a cash value. It's considered an asset to the business. And then it can also be used to fund a non-qual deferred comp plan if no death occurs. So it kind of serves as a multi-purpose. You can also use a term policy, but most companies will just do this for a short-term need, such as employee hire for specific duty that's for a short period of time, which kind of led to one of the questions that was asked by group 1. They were talking about if you have a business, private or public, imposes proper and well-structured contingency plans, such as always having someone able to step into the role if that was vacated. Do you feel key person insurance is still necessary? I really do think it would still be necessary. The reason being, this is kind of a case in point of a term policy. If you have someone that you're insuring, you're buying a policy for, you're spending the money to do so, there's value that they bring to the company that someone else, it's been really hard to find. And thinking that you have someone that's going to step into every single shoes as that next person's promoted into the new position, I got to imagine there's some downtime, there's some lag, there's some profits being missed. So a really quick and cheap way to do it would be to do some term policy to cover that individual for the time being. Some important points to remember, premiums are non-deductible, it's a business expense. And if the owner is the one being insured in the life insurance payout, could increase the stock value for estate planning purposes. And with that, I'm going to give it over to Jade for business interruption insurance.
Thank you. So now let me continue the business interruption part. For normal operating business, unexpected disruptions may occur. These interruptions may result from many sources, for example, such as contract violations, incidents of casualty, and so on. The business interruption insurance can protect against the economic losses resulting from these interruptions. Currently, I think many business owners are facing a question. So can I claim a business interruption due to the coronavirus? According to the CPA Journal 2020, the commercial property policies may include coverage for losses caused by, the name is forced closure of property by civil authority. However, the virus and the disease are typically not insured perils unless an additional endorsement was added. That's interesting facts. Also, the business interruption insurance covers the loss of earnings, the loss of income sustained, and the cost incurred to recover. Once claimed the interruption insurance, the insured must follow the procedures. The insured must prove the casual relationships like covered events must cause property damage, and the property damage must cause interruption. Next, please. To value a claim in business interruption cases, for loss of income, the insured must provide the proof that the loss of income would have earned if there are no interruptions. When valuing the claim, the consideration includes the history of the profitability of the future, the intention of the parties, and so on. So for the business, the record keeping, the books and the accounting system is very important. Essentially, the loss profit equals the business would have made minus what the business did make. The before and after method compares the revenues and the profits before and after the business interruption. Yardstick approach compares the business with a similar business to determine if there is a difference after interruption. Because it's very difficult to compare a business to each other, so it's only used for few businesses. The period of restoration is the reasonable amount of time that the insured should take to repair the damage and resume the operations. Here, I want to discuss. I have a question about my own part, and I want to discuss with you guys. You know, a lot of many businesses are experiencing a hard time now. But if they are qualified for claiming business interruption insurance, should they claim now? Because now a lot of business, they are in a bad economy. I think the valuation of for the business maybe not very good. Maybe when we consider the profit for the future, and maybe after 1 year and 2 years, the valuation is a lot of uncertain things maybe happen. So should these business to claim the business interruption insurance now for a bad economy period? Yes.
Does anyone wants to answer that question?
Mm-hmm.
Oh, so Chris mentioned in the chat box that British Open got paid. Okay.
Yeah. Yes.
Anybody wants to answer that question? So if not, so anybody wants to answer that before we move on?
Yeah, so Chris, you know, if by any chance British Open and Wimbledon were insured through Lloyd's of London, or was that an actual insurance company?
That was my guess, but I really do not know the answer, Jeff. I just know that they both filed their claims and look like they're going to get paid.
Yeah, wow, I'll have to check that out.
Thank you, Chris. And please let my team member continue.
Okay.
Yeah, so I'm covering triangulation. Apologies for the slide there. I got merged a bit. Last week, actually, Eric and Ari covered this in depth, so I'm not going to spend too much time on the definition there. But basically, it's a concept that demonstrates middle market finance theory as a holistic body of knowledge, meaning it's taking into many accounts, many factors, and not being a biased approach. And I think when you're thinking about, especially in the use of insurance, and like Jeff Sieber mentioned in the beginning, we're thinking of reducing cost of capital, and there's many different factors. And when we're looking at like the authorities of the insurance companies or the other parties involved, normal people, they're trying to push for their own agendas. And I think it's important to not allow one party to dominate these types of discussions. So we have to understand the entire framework before a specific technique or method can be considered. So that's my second bullet point there. And it's very important for these business transfers. I just want to talk about insurable value. And oftentimes this is thought of in insurance as like a value of replacement value. For businesses, just like we've talked about the different valuation models, it's kind of hard to just put a value on a business. You have to go through certain processes. You know, over time what your business is putting out and what you're bringing in, but really business owners will throw out numbers and they come to find out maybe it's not as valuable or maybe it's more valuable. I think that's why it's important to have options like the formula method or an appraisal, an outside appraisal, not having that bias approach and the objective approach from the appraisal. Chris, can you go next slide? Thanks. I like this chart that I saw and I wanted to just put it in there. I know Jeff and both, I think Chris talked about the buy-sell agreement. So I thought that was good just to see. And going back to the authority, that really needs to be evaluated when having these discussions because there's different objectives for different people. Just like that divorce example where the wife stepped in and ended up getting some of the business, that was something that obviously wasn't planned for. And I think even if you don't see that as a possibility initially, it's good to plan for these events. And I think Jeff Stein talked about having enough cash at a given trigger event. That's something that maybe a business owner is not thinking about. So it's important to keep everything in mind that can possibly happen. I know personally, I've seen business owners come into our offices and, oh, I'm never going to sell my business. This guy came to us, I think 2 years ago, and now he's talking about selling his business and he wants to look at business valuation. So things change quickly based on events. And I honestly think it was a time like COVID that brought that on. Now, he's not sure he wants to work. He wants to sell his business and kind of just live his life now because who knows when it's going to end or if the business is going to go down. I think that's really what brought it on. But just understanding those types of events, I think, and not being short-sighted in the process. Excuse my dogs. And that was my last bullet point there, different desired terms and views. It's important to know how these transfers occur and benefits are happening and that all parties are aware of how things are working so that you're just not caught in the dark when a certain triggering event occurs, especially if it's not the one that you intended to happen, like naturally selling your business through an easy process. We know everything doesn't work out as you plan, but if you plan for a certain amount of events, then you can kind of handle it and bounce back if it's not ideal. I think that's it.
All right, good job. Let's go to group one, please. We might need to ask group one to keep it within 20-25 minutes, please.
Oh, okay. I'm going to take control of the screen here. And can everyone see the slide okay?
Yes.
All right, excellent. So we are group one, and today we are doing a presentation on market value and incremental value. Again, you guys are familiar by now with who is in our group, so let's just go ahead and get started. So chapter 4 basically covered market value. So just from a brief overview, basically when you think of market value, it is the value of a business interest in a marketplace. Once you have a conversation with somebody and they state or quote that my business is worth, for example, $1 million or $5 million, what they are essentially doing is slapping a market value on or valuation on their business. And in this case, when we refer to market value, it's generally talking about the open market value, meaning that, again, if I were to want to sell or transfer the business in at some point in the future, this is basically what I would need to basically be paid in order to let go of my business interests or the equity that I have in my business. And the way market value is calculated, it is valued on a debt-free basis. So any sort of interest-bearing debt is basically deducted from the valuation of your business. Most market valuations are done on a cash-free basis as well. So meaning that when you value a business, typically you are placing a value on all the assets of a business or all of the equity on a business, but any sort of, again, kind of cash reserves or additional equity that comes into play after the deal is done is typically just maintained by the seller. Market value is ideal for trying to obtain the highest value possible through an appraisal. So basically, you want to direct your appraisal towards trying to again obtain the highest market value, because again, when you're doing a private business sort of valuation, again, this isn't, and I'll get into this a little bit later, this isn't where there's a lot of buyers and sellers, but there's going to be very few that are going to pay basically a fair value or top dollar for your business. So again, because it is so individualized, so specialized, as we've learned with private businesses, a lot of in-depth market knowledge is needed to, again, evaluate or slap value on your business appropriately. Financial intermediaries govern market value and require a point-in-time expression of value. Again, when we talk about market value, it is bringing together an unwilling buyer and unwilling seller. I thought this was a pretty funny explanation of it, but basically neither party is necessarily happy. They're both equally miserable because, again, they're kind of coming into an agreement where, you know, the seller is going to want more and the buyer's is going to want to pay less. But basically they all push both sides to the absolute limit, where if they go any higher on price or they go any lower on price, one of the sides, they're basically going to be, they're going to walk away. But in this case, we're finding this kind of equilibrium value where, again, they're not wanting to give up as much, but they're not unhappy enough to basically walk away from the deal entirely. So this value world is very interesting to owners because many of the concepts are not applicable to any other value worlds. Usually they are restricted by authorities or governing bodies in other worlds. So again, it makes it very unique as far as, again, how do I find, I guess, the optimum value, or what is the most I can obtain from a buyer for the equity in my business. Now, when we hear about market value, and this was something that I learned by reading this as well, is the fact that most of the times we think of FMV, or fair market value, and market value actually is something different, and that was very surprising actually to me. So basically, we need to differentiate between the two. So when we talk about fair market value, we're talking about a market approach, bringing in one of the three main approaches to determine it. Usually this was linked to things like real estate appraisals or sales, but the way they generated a value was basically they looked at data from similar transactions. So again, other sales in the area or in that same market, you know, when you think about like buying a home or selling a home, you're looking at the square footage and other similar or comparable qualities, and basically what did that property sell for. So this again kind of can be translated to business appraisals, where they're gathering data to find comparable or create a guideline price for a business sale. So again, there's a lot of things that go into this, valuation parameters, ratios, they're basically applied. And again, most of the time it's based on public information because it's easy to access. But the downside when it comes to private value or private business conclusions, it's not always very accurate because, again, you can't rely on public information sometimes for something that is so specialized or individualized. So the book basically states that public data is not a relevant guide when it comes to valuing middle market private stocks. So transactional data in this case is, again, more relevant. Again, I think kind of this goes back to last week when we were talking about empirical data, but basically it's more comparable than public data. So it's, and it's also becoming more readily available, which is great. Again, it provides more data and more information to kind of price it, things appropriately or fairly. So the goal of market approach and fair market value is to, again, derive a hypothetical value. It's basically saying, like, based on everything else that took place in the market, this is what you could probably expect. And this is, again, a hypothetical. It doesn't mean that this is what is actually going to end up being at the end of the day, but it gives you a pretty good frame of reference and a ballpark figure of where it might end up. So again, the full market value is a universe where a lot of potential buyers could be willing to pay this certain value, but things like synergies or special considerations are not necessarily factored in, which again is very important for private business valuations and calculating market value, because these things obviously do matter. You know, synergies matter, and aligning business models matter. So market value, on the other hand, is basically you going out, let's say I have a business and I'm trying to sell it. I'm basically trying to find obtain the highest value from a suitor, someone who would benefit greatly by buying my business and has great attraction to my business, what is that person basically willing to pay? What is that top dollar or the value that I could squeeze from this person? Because again, it makes a lot of sense. So not going to go too much into this because it's what I described, but again,
can we go back just a moment?
Yes.
So the question for everyone is that in case of the dispute that you are in the tax court, which value does tax court use?
Fair market value.
Fair market value,
yeah. Yep. So be sure, now that you know the differences, be sure to know which one that the court is looking for. Okay, good. Thank you.
So again, this is the, sorry, I should have put like a line in between the two, but the top part is basically, again, telling you the difference between the world of fair market value versus the world of market value. And again, like you see there, market value, when we're talking about two private businesses coming together, synergy matters, special motivations, goodwill, things like that, that matters in this kind of world. And then the bottom chart there, for the sake of time, I'm going to jump into it, but it's going to illustrate basically how we derive market value, which I'm going to get into here on the next slide. So when it comes to determining market value, we're thinking about, how do I even have a starting point of how to come up with this figure. So basically 4 steps. I don't know why that says 1 twice. It's supposed to say 2. But the reason for appraisal basically is the first step. You have to say market valuations. Why do I need it? Is it for strategic combinations or non-strategic transfers? What is the purpose? Why I might need to start looking at applying a market value on my business. Again, this doesn't necessarily apply to real estate or businesses heavily involved in real estate, just because again, that's based more a little on fair market value. Once we determine if market value is needed and is the right world or approach to go with, then you have to determine basically the value subworld. So it basically comes in 3 categories, which would be asset, financial, and synergy. And these, again, all are a little bit different, but what they do is try to calculate a range of values of where someone who is buying your business might be willing to pay a low price, a high price, or whatnot. Very simply put, asset subworld is basically if you valued a business strictly on just its assets, just what it has. You didn't take into anything else into consideration. Like you weren't talking about goodwill, you weren't talking about synergy, or like even necessarily like some soft assets or human capital or things like that. Financial, though, does take a look into that more specifically. It does pull financial statements into consideration. It takes a look at things like cash flow and earnings and profitability and all that stuff to kind of determine a value. And then synergy just again places a value actually on business alignment and synergies from a acquiring company. And then what you do after you determine which subworld you would want to be in, you basically calculate the benefit stream. So here is essentially, very simply put, what you get from the business if you were to acquire it. Like what is your economic benefit to you or to the buyer? And it's all dependent, again, kind of on the value world which you use. So again, it could be based on earnings, cash flow, and distributions. It could be based on assets and what that could do for your business. It could be based on synergy. And again, all of this stuff is kind of forecasted maybe on a financial documents, using financial documents or a pro rata basis. But all of it at the end of the day goes to point number 4, where it's basically your private return expectation or PRE. And this is, again, very simply put, your expected rate of return. What is that investor going to need to see in order for them to, again, kind of like acquire your business? Like what sort of value or benefit can it add to the acquiring company if you were to sell it? So this can be stated as like a discount rate, a capitalization rate, an acquisition multiple. This will also, the way it's calculated will, and the way it's derived does change basically depending on the investor profile or the acquirer. If it's an individual or a group, or there's no multiples found, then there could be different methods as far as figuring out or calculating the private return expectation. And with that, I will turn it over to Jeff to discuss levels of private ownership.
All right, so the remaining chapter looks at the level of private ownership, and especially if you're looking at a single owner, or if you're looking at partial ownership, which I'll cover in a few minutes. And what it talks about as well is how do you drive the value. You can do a direct analysis, or there's indirect, which we'll cover in the next page. We'll start with the 100% owner, because that is the easiest to think about or try to analyze. And actually, go back for 1 second. So the book, the chapter actually references a handful of databases that are available. And I looked into them. There's heavy subscription costs. This one, BizComps BVR, does provide a couple example deal sheets. So this is one that we'll use a tiny bit for my example here that describes a whole lot of different facts and figures. I think it's a sheet metal company. It was very valuable. So the quick other big component is, again, the direct valuation is looking at a comparable transaction, a comparable sale for that business, right? So trying to do kind of an apples to apples comparison. If we go to the next slide, the other route would be an indirect valuation, which is going to be using some kind of different reference or calculation, basically kind of in our world, right? Multiples. And so trying to figure out what would be a fair estimate for that company. What I came across in these sheets here was actually the market value of invested capital. It's a little bit hard to see. It was in the top left-hand side, and it also references the selling price of this hypothetical example. And so I hadn't come across it before. I had to look it up. And quick thing here is the invested capital is actually equity plus debt, much like Eric was sharing. Now look at the market value of that, right? So it's not book value, it's using market value. And then another quick reference is it's much like enterprise value, which I had read about a little bit before, for a public company. And so it's a bit of a better valuation, or really a core number for a sell, like this type of scenario here. So we go to the next page. This shows a little bit more about the deal terms. And I thought this tied in very well. And actually, even the other Jeff was talking about quite a bit with the buy-sell information. They're kind of almost, in my mind, flip sides of the coin, right? You have the ownership agreement, and the booklet talks a lot about how important buy-sells are, all the different components that are going to go into it. This also talks about the deal terms as an individual sell in a public transaction, right? Or a private, but a non-ownership transaction. And this describes quite a number of different pieces that are out there. So not only the cash payment, which was for the market value invested capital, but even this one shows how there can be earnouts, there could be paying over time, there could be additional cash, effectively bonus price increments, a non-compete. A different, actually, a quick side note is a different sheet that I looked at from these examples. It actually gave a dollar figure for the non-compete. In other words, it was a value add back into the transaction. And this one has an employment contract as well for the departing owner. And so I think this ties in really well with the question from group 2, which was, hey, if you have a opportunity, you can either use, basically it's an indirect or a direct valuation for a financial planning practice that's selling, which would you go with? And the short answer is it depends, and maybe even more so, it would be great to use both, right? Which I think a lot of what we're learning is trying to figure out the different values and how can you size up what the transaction would be. Because I think a lot of the question was around what if you have an aging client base in that financial planning practice. I think if you had to choose one, you'd want to go with, and the name itself helps lead to the solution, which is a direct valuation. So if you could look at a very comparable other business with ideally similar clients' ages and such, you'd be able to figure out much more effectively what a fair valuation would be, because ideally that age discounting, I'll call it, would already be taken into consideration. The next slide here for a moment is from that enterprise. The book then goes into the other levels of private ownership and breaks them out. The spacing got a little bit wacky there. The control level, which would be if you're a partial owner but a majority owner, a 50-50 owner, which it points out is actually very problematic, and then a less than 50% a minority interest owner. And so it describes the book, the author describes that there's the direct and indirect valuation methods, but actually shows how virtually, and I was actually surprised to see this, in virtually any of these scenarios, the problems that arise, number one, are very high, and the effective discounting that could take place can be quite high as well, all the way down to what the author points out for the minority interest level is how it can be virtually a worthless ownership unless it is explicitly spelled out very well in something like a buy-sell, because nobody's going to want to be a minority owner with very little control, if any, for just a revenue stream they have no control over, right? So much like the other group, this section really harped on how ownership agreements are very valuable to do from the start when times are good. They come in handy for when you're trying to value down the line when things are changing. So there's my section. Next up, I think, is Jordan.
Awesome, thanks, Jeff. And I'll try to go quick here. I may have to gloss over a few slides, but the chapter 10, incremental business value, had a lot of great information in it. So I'll start with this quote in the upper right-hand corner. A quote from Peter Drucker says, "Until a business returns a profit that is greater than its cost of capital, it operates at a loss. Never mind that it pays taxes as if it had a genuine profit. The enterprise still returns less to the economy than it devours in resources. Until then, it does not create wealth, it destroys it." So I like this quote a lot. I think it does a great job of summarizing the concept of IBV, or incremental business value, and the fact that a business isn't creating wealth until it has a positive IBV, and rather, if it's instead of creating wealth, it would actually be destroying it. So going down the slide here, the world of incremental business value, or IBV, considers the creation, measurement, and management of a company's IBV, which basically defined as a return in excess of the corresponding cost of capital. So that's the main takeaway for IBV is the business, or is the investment having a return in excess of the corresponding cost of capital? By understanding how the value is determined and influenced, the business owners are better prepared to increase the value of their business. I like the fact the text pointed out that the world of IBV is separate and distinct from all other value worlds. So we've been learning about all these different value worlds. We've mentioned some of them today, right? The financial, asset, and synergy value worlds are some of those. And this one is completely distinct and separate from all of those. I like the fact that it pointed out that the authority for the world of IBV is the academic community and management consulting industry, which developed most of the IBV conceptual framework. So last week I had part of my section was on the authorities, which were more, some of those in the other value worlds were the IRS, the tax courts, things like that. But in this particular value world, it's the academic community and the management consulting industry. And then the IBV world generates and uses an incremental value calculus. So I like the example that the text provided here, where for instance, if a company generates a positive IBV of $1 million, then this means that the company has bettered the shareholders' position by 1 million, not necessarily that the company is worth $1 million on an enterprise basis. So next slide, please. Awesome. So the purpose of the IBV world is to measure the incremental value or incremental change to IBV in an entity over time. So this makes IBV a popular tool for use in bonus plans and capital allocation systems. So bonus plans for executives and how to allocate capital and things like that. Not necessarily as much of a tool used to, when selling a business, was one interesting thing that I learned from the text. So, and unlike the other value worlds, the IBV valuation process enables the business owners to determine if an investment is likely to create value before actually making the investment. I'll just jump down here. I know we're short on time, but if managers do not consider the cost of capital when making investment decisions, they risk destroying their IBV right from the get-go. So if the investment wouldn't have a return in excess of the cost of the capital, then it obviously wouldn't be a wise investment to make for the business. We can go ahead and skip to the next slide. Oh, I'm sorry. I think Professor's writing on there.
I was going to say that it's not always, but if you have a compliance situation, then it may not generate any value.
Correct. Yeah. That's a great point. Thank you. Next slide. So this just talks about one of the concepts, so economic value added, or EVA. I'll just try to summarize this really quickly, but basically what that is EVA measures wealth changes to the shareholder and is one of the methods used to track IBV. And simply put, EVA says that earning a return greater than the cost of capital increases the value, while earning less than the cost of capital decreases the value. So that's pretty intuitive, common sense there. And then EVA does not rely on accounting measures of investment, but rather it relies on an economic view that captures and considers period costs, such as advertising, ongoing research and development, as part of the economic investment. And then the point at the bottom there is it's just stating that traditional accounting methods, some of those being, earnings per share, EPS, or return on investment, ROI, they've been used for years for evaluating strategic decisions. However, over the last 10 years, key consideration has been that economic concepts drive value rather than accounting methods. So if we want to go on to the next slide, I'll just basically, for lack of time here, just know that there are several problems that the text pointed out that come along with using some of the traditional accounting methods. Some of those being, that they ignore the time value of the capital invested, they can be subjective, they exclude the consideration of risk. And that's sometimes one point that I thought was interesting is that managers may be motivated to manipulate accounting figures in some of those methods. So that's just pointing out more than anything that there's some problems that come along with using these methods. If we want to go to the next slide, net present value. So NPV is probably the most frequently used method to measure IBV, simply because it has been around the longest. As all of us probably know, NPV is calculated by adding the initial investment, represented as a negative cash flow, to the present value. And then NPV is a key indication of whether a project or investment increases the investor value. So it's pretty intuitive. If NPV is positive, then the financial value of the investor's asset should be increased. If it's zero, it's basically an indifferent investment. The business or the business owners would be the same whether or not they make or do not make the investment. And then if NPV is negative, then it would not be typically would not be a financially attractive investment to make. So just some things to keep in mind there. And then if we want to go on to the next slide, the text did explain that most private business owners actually do not rely on NPV for their investment decisions because of the potential pitfalls of using that method that I've included here on this slide. We'll just gloss over those if that's okay. Just wanted to go to the last slide that gives us the formula. So IBV measures whether a company's recast EBITDA is adequate compensation for the total cost of capital employed. The formula for IBV is recast EBITDA minus the investment times multiplied by the cost of capital employed. Recast EBITDA is used because it reflects the economic profits available to the shareholder, and also because it's more accessible to private companies and is consistent with the standards required for middle market businesses. So in summary on this IBV section, we just want to make sure we addressed the question given to us by group 2, which was, just to summarize that again, the question said, given that incremental business value increases or decreases based on a company's access to capital, how can this affect the buyer in our industry when trying to justify their value add to the seller? So our answer on that is addressing the first part of the question. Great question. IBV doesn't necessarily increase or decrease automatically based on a company's access to capital. Like we've summarized here, it's essentially the return above and beyond the cost of capital in excess of that. I like the question though, because regarding how a purchaser may use, their access to capital or lack thereof as a way to add value to the seller. So if a purchaser doesn't necessarily have access to capital, or if the capital is very expensive, then they would need to add value to the seller in other ways. So for our industry, for example, in order to entice the seller, they could talk about some of the relationships they may bring on board, the synergies that could exist between the companies as they merge, or maybe key employees who have a particular area of expertise that could add value, in the merger or the acquisition. So that'd be some things that would be applicable to our industry. And then a cheaper cost of capital would likely lead to a potentially higher IBV. just because, or at least an easier path to a higher IBV since the cost of capital is less. So that's kind of an answer to that question. So hopefully that addresses that. And just want to, I'll turn it over to James now for his section.
Thanks, Jordan. So I'll be going over private cost of capital. And private cost of capital is kind of an alternative method to IBV that tackles some of the pitfalls that Jordan talked about in his presentation. So when valuating privately held companies, it's a much different process than valuating public companies, because less than 0.001% of private companies will ever go public. And private companies are a much riskier investment than public companies, making the cost of capital generally higher. So with public companies, there's a lot of data that we can use to compare companies and figure out expected returns. That information doesn't exist for smaller privately held companies. In order for private capital providers to determine if a company is a good investment, they need to determine the expected rate of return of that company. So the private cost of capital formula seen here on the slide provides a discount rate that aids investors in the decision-making process. It's calculated using the number of sources of capital, the median expected return for capital, which needs to be adjusted for the risk of the company, and the market value of all outstanding securities. So to determine the private cost of capital, there are 4 steps. Let's first determine the appropriate capital types that will be used. As Jordan discussed, different capital providers are going to require different rates of return, and it's important to choose the appropriate type of capital. The median expected return for each type of capital can be found in the most recent Pepperdine survey. And the next, you must determine the market value of any outstanding debt and equity positions. The third step is to adjust the selected median capital type for risk. In order to determine the risk adjustment, an appraiser must compare surveyed and subject credit boxes for each capital type. Using information from the company's cash flow statement, the appraiser can calculate exactly how risky a company is compared to other surveyed companies and adjust the median expected return accordingly. And then finally, the percentage of capital structure must be calculated for each cap and then added up to the individual costs. So for example, if the cost of debt is 10% and the cost of equity is 30%, and there's a 50% debt and 50% equity, the private cost of capital would just be half of 10% and half of 30%, which is 20%.
Okay.
Having this data.
Can I stop you for a moment?
Mm-hmm.
All right, we only have about a few minutes to go. So let me share my screen and let me just kind of wrap up. Thank you for doing a great job on the presentation. I'm going to share a couple of important factors that, so as I will share the slide so you will be able to see. So the private capital, cost of capital basically is the WACC here. Let me make sure I put it out. I wanted to make sure at least you have an idea of what that is talking about. So this is your private cost of capital. And this is the IBV. So there is a difference in between those two. And the IBV doesn't necessarily take the time value money into consideration, but EVA does. EVA does use the time value money to do the consideration. Both of these methods are not necessarily the preferred methods today. Today is more of a shareholder value. And there's a whole different calculations that in there. The other things that I do wanted to share that was here. So part of the methods that group 1 had mentioned about, there are several different type of methods determining the company value. One of the more popular one, which is using multiples times the EBITDA. And that will really, depending upon, there are 9 different industry there, as well as different size of the EBITDA. So depending upon the industry, depending upon the EBITDA or size of the EBITDA, the multiples do vary. And this is the most recent Pepperdine University survey, which you have a copy for your case study this week. And so keep that in mind. The other things that previously, I think it was Jeff mentioned about using the deal stat. So deal stat, so remember Pepperdine University is a survey. So this is a survey. This is based on owners, based on intermediaries, that they're thinking about how the value is supposed to be. Deal stat is actually the actual buying and selling data. So there are two different set of data you're looking at. So when a appraiser comes into a company, they actually compare these two sets of data. The subscription to the deal stat is actually not that expensive. As Jeff was talking about, I forgot to renew my subscription. Anyway, the other thing you have to watch out for in terms of the appraiser, for those of you who do buy sell, is that when you hire the appraiser, that appraiser preferably has to specialize in that industry. So for example, take financial planning as an example. If you just find someone off the street, that appraisal value isn't going to do you any good if you're selling. If you're buying, that's okay. But if you're selling, you want to have the highest price, then a specialized appraiser is going to help you with that. So that's something to make sure you keep in mind. The other thing, so these are the triggers that we mentioned. These are the two that didn't mention in a slide before in group 2. Okay, so quickly about next week, and that is that you do have a discussion, and one of you mentioned to me that there's some information missing, so I corrected that. There should be a PDF file for you to read, and then there are 3 questions for you to answer accordingly. You have a case study that is a part 1 of the case study, and there are 3 questions associated with that. So read through the case study and answer those 3 questions accordingly. Then you have your week 4 group presentation for next week. I think the group 1 is 26, 23, I'm not sure, but check the Blackboard accordingly. So this week you don't have the final paper, but I would encourage you to revise your research questions so you get ready for the literature review in week 4. So with that, do we have any questions from anyone?
Professor, I have a question. I can't access the recording last week. It said I need permission.
Oh, interesting.
Yes.
Did you log in from?
Yes, I log in through my school email.
Oh, interesting.
Yeah, I want to check some information, but I can't.
Okay.
I can't get it.
Let me double check.
I have the same thing.
Okay, so you have the same problem with the recording as well? Okay,
Yeah.
Let me double check. It may have something to do, I need to download it and upload somewhere first. But I guess
yes.
let me check Zoom first and I'll get back to you guys. Sorry
thank you.
that.
Thank
okay?
you.
Any other questions? Yes.
Where is the case study on week 3?
So if you go to the week 3, we are at week 3, right? So week 3, if you scroll down, you see the case study. Oh, it's hidden from students. My mistake. I've been talking and not knowing that it was hidden. Why is it hidden? Huh. I will make sure that it gets turned on for you guys. The due date is correct. Okay, let me make sure it's turned on right after the class for that. Okay, any other questions? Great job, guys, and I look forward to your next week's assignment. If there's any other additional questions, feel free to reach out an email, and I will see you next week. Keep up the good work, guys.
Thank you. Have a good night.
Have a good one. All right, take care. Bye.